Now we're taking a look at some movers. Uber in focus, and we have Diane King Hall with us, host of Morning Movers. She's been watching Uber today, this morning, rallying on some news. Diane.
Yeah, look, it's off the back of a boost to the price target for Uber. Shares moving a little bit higher, but look, they've been a significant outperformer year to date when you compare it to the performance of the S&P 500. This even more bullish view is from JPMorgan Chase. They're boosting their price target on shares of Uber to 105 from 92. They're reaffirming their overweight rating. You know, that's essentially the equivalent of a buy rating. This comes after some upbeat meetings with Uber top brass over there. They like their performance against long-term goals. They see strong performance. They think they're on track or ahead of their 2026 targets. They're expecting that mid to high teens bookings growth. They're expecting 35 to 40% EBITDA growth. And they like the story around the cash flow conversion. So in other words, JPMorgan Chase sees Uber delivering strong, profitable growth in its core ride-hailing and the delivery business. We know that Uber Eats has been a big part of the drivers for Uber, more diversified when you compare it to its competitor Lyft, and so you can see why it's been outperforming not just among the outside of the S&P 500, but outperforming its group as well. And of course, they're investing in future growth opportunities. So JPMorgan Chase sees these as catalysts for the road ahead for Uber. They think their partnership with Waymo in Austin showing early promise there, Nicole, and they expect that autonomous vehicle narrative to strengthen here, especially with the expectation for an expanded rollout, Nicole.
Yeah, and over at Pershing Square, Bill Ackman, sort of doubling down. I don't know if it was the exact number, but my point is he's upping his investment in Uber, so liking that overall. It's nice, and what an incredible run. I mean, just even for year to date, up 54%. That's right. And new highs.
And right, an incredible run, especially when you think about, one, the pressure that it faced last year with all the concerns about what Tesla would do with autonomous vehicles. It's shaken all of those worries off. And if you look at it on a one-year chart, it's up more than 40% on a 1 year. So it's just had strength, again, especially as you compare it to the broader market. And you mentioned Bill Ackman. The analysts are largely bullish on Uber. Most are in the buy camp, Nicole.
All right. And next up, we're taking a look at HPE Enterprise. Here, an upgrade there.
Yeah, shares are a little bit higher off the back of this, up more than 1%, around 1.5% right now off the back of this move. Evercore ISI behind this upgrade today. They're upgrading HPE to outperform from inline. So they've moved from neutral over to the more constructive camp. Their new price target, $22 a share. They previously had it at 17, which obviously it's increase from there. They see an attractive risk-reward profile here. They think that the profile could be appealing, especially for investors who have a longer-term view, longer duration, long-term investors. They liked the acquisition, Juniper acquisition. They think there's cost synergies there. They think that will be a driver with regard to EPS. But they did give some scenarios in case that there's any kind of breakdown there. They do still see margin expansion even without the Juniper deal. They think HPE will be able to lift margins on their own as well. So there is a range. They see the stock moving in that case, and they see that range as being 26 to 31 bucks a share. So they see there's a very balanced perspective in terms of how they also gave the view of if there is a status quo situation for HPE, no deal, no major changes, and then they think the stock is likely supported a little bit below where it is now. So bottom line, in other words, they see multiple pathways to upside when it comes to HPE, limited downside risk here. In terms of analyst views, Nicole, analysts lean neutral to bullish on this stock. It's a slight tilt to neutral here.
That's good news there. I mean, also just their continued work that they do, the collaboration on AI factory solutions with NVIDIA, the CEO of HPE saying they're co-engineering cutting-edge technologies that have been elevated by the robust solutions of HPE. Makes you feel that on the AI journey, they're in the game.
Right, exactly.
There are some companies in tech that have had to reinvent themselves or being left behind. I mean, just this kind of language and working with NVIDIA, the top top. You know what I mean? That looks good. And especially when people are still wondering, you know, do I want to be alive in the tech trade?
Yeah, it's true. And look, we've seen significant recovery in the tech trade, especially when it comes to the Mag 7. So they're returning to that more, you know, kind of the halo effect that you had around those, say for a few of those. Like, for instance, we know Apple's been under some pressure still year to date, even though you've seen quite the recovery in other members of the Mag 7. But going back to HPE, Morgan Stanley also out boosting their price target on this one. They're matching the move by Evercore ISI. They've got a $22 price target, but they are still in the neutral camp. They're equal weight on this one.
All right, and then there's MongoDB,
That's
MDB,
right.
down 1.8% this morning. Some thoughts there?
Yeah, so MongoDB is under some pressure today. This is off the back of a downgrade by Loop Capital. They've downgraded it to a hold, so they've gone to the sidelines on MongoDB. They've slashed the price target majorly to $190 a share. That's down from $350. So that's a more than 40% cut on their view on that. So they have a more cautious outlook now when it comes to MongoDB. Their core concern is Atlas platform adoption here. They did some, you know, we use this phrase channel checks. Essentially, that's their version of the due diligence. They think there's been weak adoption of Atlas, its Atlas cloud platform, and they just see a decelerating trend when it comes to this growth, especially when it comes to AI-related workloads. So that's part of the concern here. And they think that because of what they're seeing now, that points to a slower trend when it comes to AI workloads for future growth. And it's a flag that they want to flag here. We'll call it a red flag, for lack of a better way of capturing that. And they think that their go-to-market strategy, which is focused on large clients, large enterprise clients, isn't really gaining the traction that's needed, again, especially when you think about Atlas adoption, Atlas cloud adoption. And so they think that there's, you know, it's a fragmented space here, and there's no clear dominance here. And so because of the competitive landscape and that MongoDB has not consolidated market share here, this is the feedback they've gotten from channel checks. They just think the view now is cause for caution here. So again, you're seeing some pressure on shares.
And you know, demand visibility is such a big part of this. And with the sort of reduction that we saw in tariffs with the U.S. and China last week, that gave a boost to some of these names and, you know, brought sentiment up for the time being, keeps supply chain alive. But it doesn't give you the longest term vision, and that's sort of the thing.
No, right. And then so, you know, you add to this the, you know, kind of downward trend that MongoDB has been on, and it's adding to the pressure it's on. It's underperforming the S&P 500. We know with where we are with regard to this 90-day pause, it's been, you know, it's returned more bullish sentiment to the market. But MongoDB not a beneficiary of that the stock down more than approaching down 20% year to date, honestly.
All right. Thank you, Diane King Hall. Great to see you.
Good to be with you.
Thank you so much.
Thank
Good luck there at Uber, HPE, and MongoDB.